Hey, what's up, everybody? I am Dion Brown, and you are listening to and or watching Man versus Brand. We live in an interesting time. We live in a time that I think harkens back to other periods in our history where we saw great change occur. We understand that change often brings about one of two reactions. People either embrace it or they fear it. Now, embracing it doesn't mean that you have to be happy about it. It doesn't have to be the change that you were looking for, but we recognize that those who do not embrace change and progress are doomed to be left antiquated. So, what does that mean for us? What does it mean for us culturally, socially, financially? What do we do when change happens and we have to figure out some way to then embrace that change? Well, if you talk to folks, they'll often mention the housing crisis that happened in the 2000s. If you talk to other folks, they will talk about the Great Depression that happened. We also have the pandemic that happened. And we're moving from the great industrial revolution to the technology revolution, or from some folks, we're already firmly in it. You just might not know that we are. Well, hey, I don't pretend to know anything about any of this, even though I might. Guys, listen, you might hear something cool from me, you might not, depends. I'm not a master of everything. So therefore, I know a little bit about a little bit, but I know a guy who knows a lot about a lot. On this episode of Man vs. Brand, we're going to talk to Patrick Grimes. He is the CEO and founder of Invest on Main Street. He's also a co-author of the Amazon #1 best-selling book, Persistence, Pivots, and Game Changers. He is often cited in multiple publications. Forbes particularly likes my man over there. And so if you want to know more about what you can do with your money, how this shift in the economy might affect you, possibly some strategies around real estate investment, this might be the guy for you. At the very least, you might be interested that we're both two ballhead men who are hosting a really great and interesting, funny podcast. And that might be enough for you to tune in for the rest of this episode. I'm Dion Brown. I appreciate you guys for listening. Patrick, why don't you introduce yourself?
Dion, I'm excited to be here. I've enjoyed our relationship so far. This is going to be a great time. So I'm Patrick Grimes, CEO and founder of Invest on Main Street. We do private equity investments for busy professionals. And building the brand has been one of my passions and one of my challenges. So looking forward to the conversation today.
Absolutely. All right. So we have to kick off this episode. For the people that's watching this on YouTube, describe what area this background is in. Don't give too much detail, but I want to soak in this beautiful background that's happening in your windows. What body of water is that? Is that a body of water?
Yeah, our backyard is over top of a lake. We're in Orange County, Southern California. We were in Hawaii during COVID, and when I voted, we moved back because we just had a boy. My wife managed to find a place that looks like Hawaii.
Congratulations on the child and the move. I love a great scenic background. I'm fortunate enough to have a mirror, which is like a lake in Central Park, in my windows. Guys, you can't see it because my window shades are closed. But I think waking up to a body of water is probably the most tranquil thing in the world. But guys, I mean, listen, this is a blessing, not the average or median. So just acknowledging that background, man, that's an awesome background. All right. So let's talk about how you got into the investment space. Talk to me about what that looked like. What was your career path that took you from where you started to where you are today?
Well, so I actually trained and educated as an engineer, did mechanical engineering. My first job out of college was with a machine design firm. I was doing 3D modeling, making automation and robotics solutions for med tech and aerospace, EV vehicles, a little defense here and there. The owner of the company, at one point, we got really close. He told me that his only regret was not investing more sooner into real estate, which was crazy for me to hear because here he is, owns this really high tech, killing it firm's just amazing. And then I learned that him and his partner are dumping everything into real estate, and they had been around long enough to know that the high tech world is cyclic and you can lose it all. And the way to really build and park your wealth is in real estate. So I took his advice and I did a bunch of research and I dumped everything I had at the time into what I thought was the best returning deal, and in a pre-development residential community, and it all tanked in 2009 and 10, and I lost everything. So that was my first venture into real estate.
Now, so many people that invested in real estate said they tanked. So many people also cite that it was the beginning of the foreclosure sort of mass boom of making money in real estate. Do you find that the adage that in economic turmoil, the best opportunities arise? Like, is that something that now looking back at your own history in real estate and in finance, in some aspect or in the investment space, you found that in turmoil and economic turmoil that that there are possibilities for positive growth if you're able to capitalize on it?
Absolutely. And I wasn't during 2009 and 10, which I'm happy to say is not the case today. We are cash heavy and ready to pounce. And we have actually acquired 4 properties so far, call it, that are distressed operators, that pennies on the dollar that we can get a capital out within a year. But back then, coming out of, I was 9 and 10 and 11, I was trying to navigate staying out of BK. I went through foreclosure and ended up paying on debt forgiveness, taxes. So it took me quite a few years to recover. I do think that you can make money in any kind of market cycle in real estate. Now I do. When you structure the investments with a long-term focus, reasonable returns, you fix the debt so interest rates won't tank you, and you low enough leverage, and you buy for cash flow. That's one of the things that's beautiful about real estate and lessons learned for me. So yes, you can certainly buy very discounted deals and try and accelerate your path to wealth if you wait for a downturn and you sit with cash capital heavy in your account. But if you do that, and you would have spent the last over 10 years just with a bunch of cash in your account, losing it over inflation. So it's more important to put the money to work. But now that we're there, you can have the best of both worlds. You can put it to work.
I would say, right, that I think that there's this kind of, sort of negative outlook that folks might have with saying, like, how can you profit from when there's economic turmoil? But really, it's just about acknowledging that this thing is happening, that it's happening regardless of whether you benefit from it or not. And if you're in a position to leverage a circumstance and benefit from it, then you have done to the best of your ability, created an opportunity for yourself, right? So would you argue that, like, there's really no sort of value system to when you invest and why you're investing? Because really so much of it is just about finding opportunity, and that opportunity might be in price, it might be in space or location, it might be in economic time period, it might be in your own lifespan, that really it's just about taking an opportunity and doing the best that you can with it?
In all of our investor decks, we have put a line, and part of our mission as a company is that we improve the lives. And not only do we provide inflation hedged, tax advantaged, recession resilient returns to our investors, but we work to improve the quality of life for our residents, cleaner and safer places to live. So a lot of the opportunities out there, if there is a struggling owner and they're distressed, oftentimes who gets the short end of the stick are the hundreds of families living in those apartment communities. There was a time that I red-eyed from Hawaii out to Houston, and I found a property. We were told by a broker that there were 19% of the people weren't paying rents. The owner was distressed. He didn't have money to fix it up, and he needed to get out. So we went out there, checked it out. I walked the units. I found, we uncovered a stack of unanswered maintenance requests about the size of a ream of paper. We went through the units. We found flood units. We found fire units.
Pause for 1 second. Describe for me a ream of paper. Like, I'm not being funny in the fact that I don't,
right?
I can't visualize it, but I feel like it's a very specific term with a very specific visual. So, what does a ream of paper look like? Like, is it about? And for the folks that are listening, I'm sort of doing about, I don't know, a foot with my hands. Is it about a foot of paper, or is it about a half?
Well, if you put your iPhone flat on the table sideways, so short side up, right? That's about the thickness of a ream of paper.
That's a considerable amount. That's pretty considerable. Okay.
For a 300 unit complex, they had been neglected for a very long time, and that kind of thing frustrates me, right? So was the owner distressed? Did we swoop in? Did we get it at an incredible discount? Well, he deserved it in that case, right? I was happy and delighted to take it off his hands, because we immediately went to work fixing all the rodent issues, bug issues, mold issues, leaking issues, and foundational issues, and everything that caused us to be a miserable place that resulted in the residents just simply not paying. 19% of the residents not paying their rent. And so I like to think that we're actually doing good by our investors and doing good by the residents in our communities. There are some opportunities we find, which are families that inherited a property from their parents and they just want to get rid of it. They don't know how to manage it, but we're getting a discount on it. Our last acquisition in Atlanta, the individual managing it struggled during COVID. He had about 15% of the people not paying rents. And so we didn't have money to continue to renovate. All the rents were below market. All the units needed upgrading. And then a building burned down. And he left it down because he didn't have the capital to recover. So, we helped him out by getting him out of a building that he was doing a terrible job managing, and we helped the residents out by rescuing it. So I like to think that we're making a positive impact on the world. It's not always the case. And we all hear stories about the slumlords out there. But a lot of those slumlords are the ones that lost their buildings during COVID, right? I think if you take care of the residents, they'll take care of you.
But sort of on a broader note, right? I think that all of those are great points. I think maybe I was just referring to this idea that you can have some sense of a positive investment and find an opportunity, right? And I guess to your point, also do good in that with that opportunity, right? That there really is no sort of sense that the taking over or investment in a property is by no means just a cash grab money play, that there is this sense that you can have an effect of good in the spaces where you're investing in, even if that investment is because there was an opportunity that was presented through whatever the circumstance was.
Right. Exactly. And I think you can do a lot of different things on this planet, and you can do them in a way which is a positive impact or a negative impact. And I could come on stage and have the exact same company and say that, no, we were predatory. We look for people that we can take advantage of. We buy notes for people that are struggling, and then we take it over and then we turn them into slumlord properties. We never update them. We squeeze them dry. And there are, in fact, operators out there that are like that. I think we have the luxury of making the decision ourselves, and we're very transparent about it. We put it right on our investor decks, so it's in front of everybody. And we're not looking to squeeze every last penny out of the property, not only from the improvements we make to the property, but also we put a huge down payment so that we know we're going to cash flow strong, so that if another recession happens and we do get vacancies, we can still pay our bills. We raise a bunch of extra capital for the purposes of just having reserves. So we're not the person that maybe in a bad year when vacancies are high, like they've been, and then there's a hurricane or a tornado or an earthquake or a fire, that doesn't gouge our cash flow to where we can't pay anymore. We need enough capital to be able to ride it out. 6 to 8 months extra in operating expenses is what we raise. So we can ride out a temporary natural disaster and then get recouped from the insurance proceeds, which sometimes takes a while. So that way we can. Mm-hmm.
Oh, no. So I was going to ask, right? So when you're looking at properties to invest in, what are some of the criteria? Like what when you're doing I would imagine nationwide search, regional search, global search for attractive properties, right? Talk to some of the folks that are maybe entrepreneurs that are looking at real estate investment. I was a team leader for Keller Williams and a consultant advisor. So we have a lot of real estate folks that listen to this podcast that are in the investment space, both in the residential, the commercial, meaning commercial, general commercial, and then commercial as in residential properties that are over a certain amount. So talk to us about what you look at when you're thinking about investing in a property. What's some of the criteria?
Yeah, well, it's a great question because I lost everything in 2009 buying higher risk, pre-development, highly leveraged, not cash flowing assets in recession affected markets. So I learned the hard way not to be the hare, to be the tortoise, and to look for safer markets that are more resilient to recessions, markets that have influx of people moving and jobs moving into the markets, so that even if there is a recession, you have a tide rising in the area. And that's because they're legislative friendly. They're legislative friendly for the tax friendly for the residents, they're tax friendly for the businesses, and they're legislative friendly for the landlord friendly places. And that helps because then we have more stabilized income. If somebody stops paying, we can get them out. If we spend, $10, $20 million improving a property to make it a cleaner and safer and better living experience for our residents, then we can raise the rents. And so we make sure that these are market resilient, limited exposure to market volatility is what we call it. They're in the expansion curve and they're legislative friendly. And then we look for specific assets within those. And our asset strategy is shifting a little bit with right now, we're starting to see opportunities like 2009 or 10, where there's operators that are struggling with interest rates going up, didn't get the right kind of debt, struggling with the coming out of the delinquencies that they experienced during COVID, and they just want out. And we're looking at a little different lens because now we're finding not just the typical deals that we had in years past. We're finding deals where we can buy it and get our capital out in 6 months to a year and still own the property. And so that's why we're looking at our opportunistic fund that we have, and we're being able to pull much higher returns through the properties that we've done using this strategy. And so we're building a fund around that so we can come in cash heavy and buy it all cash. And so that's a little different than our typical strategy because now we're looking for opportunities, kind of mom and pops, where they want out and they're willing for us to do a cash buy. And we're looking for ones where we can get our capital out in the first 6 months to a year. So that's new. And that won't go on for too long. I think maybe for the next year or two, maybe 3, we'll be able to continue to find those properties, depending upon how confident you are about the market stability. And then we'll go back to our kind of traditional strategy.
Absolutely. So now more than ever, I think the person on Main Street, right? That's on Main Street. The folks on Main Street are considering themselves to be interested in investment, right? Real estate investment. It's become sort of a hot topic right now. If I'm listening right now and I'm considering investment, right? Like I'm considering an investment as an individual and or as a partnership, right? Maybe I have someone else that is also interested in investing with me. What are some things that I need to consider before I really tackle investment as a strategy for gaining wealth?
Well, so I was one of the high paid professionals out there that tried to make it big in tech. Got some good advice early on to put my capital outside. Then I tried to do the DIY version of real estate. I thought, well, I'm really good at tech. That means I'm also really good at real estate while being really good at tech. And that just meant I was slaving away, moonlighting it, whether it was pre-development or in the single family game, trying to buy and renovate and hold or flip properties. I couldn't, it was a slog. And so I tend to think individuals like yourself and your listeners that have substantial income, something that they're really good at, to explore the world of passive investments. So larger syndications, private equity firms like mine, we have a footprint in the growth markets. We have track record in the growth markets, not in your backyard, but in the landlord-friendly, tax-advantaged places where everybody's moving to. And you can invest entirely passively. And so my general sense is do what you're good at, make your income, spend your time with your family, friends, and hobbies, and partner up. And it wasn't until I started partnering up with larger firms that I actually got free and was able to get married and then eventually start a company and walk away from my 9-to-5 engineering job. So it was the passive path that actually got me free, believe it or not. So I recommend people work with those kinds of assets and those kinds of firms.
All right, cool. So you are a co-author in a book that is an Amazon #1 bestseller, mentioned at the top of the episode. Persistence, Pivots, and Game Changers. So talk to me about that experience. As someone who, as we've mentioned in this episode, has sort of walked through different roles and industries. How was it to be an author, man? What was that experience like? What was it like having this collaborative book come into your life? Was it at a great time? Did you know what you wanted to talk about? Was it something that you really had to pull from? Talk to me about the authorship path that you undertook and what you learned about yourself in that process.
Well, so I traditionally am the analytical analyst, engineer, kind of keep your head close to the grinding wheel and get the work done.
Okay.
I'm not a flashy, get out there in front of people. And it was a couple years back that I attended. In fact, we were still in Hawaii at the time. I attended an event by the real estate guys, and Russell Gray made a recommendation. He said, look, you've done a lot of cool things and nobody knows about it. Nobody knows you. But a lot of people can be inspired by your journey, and you have passion to educate people. And instead of doing one-on-one calls all the time and having just organic growth from just referrals, why don't you get on some stages? Why don't you get on a podcast? I had never done a podcast. I had a few $100 million in management. I'd never been on a podcast.
Yeah.
And it was terrifying. That's my response. And he said, well, let me hook you up with some people that can help you put a book together. And so that's what I did. I joined Phil Collins, lead guitarist at Def Leppard, NBA, NFL players and coaches, got a handful of authors here. And Brian Tracy did the foreword.
Yep.
It did become an Amazon. And the journey was frightening because the first time I ever got my story out there and into the public, I had a writing coach help me understand, build some confidence. And I wrote it myself, and my mother helped actually. So,
Hey, shout out to
yeah,
her.
team effort, and but they helped me model like, hey, why don't you bring this down? Why don't you pull this out? And here's some areas you got some hole here. This story doesn't flow.
Yeah.
And it just was, and I would go off and sit at Starbucks, on a Friday night or a Saturday even, and I would just work on it until it finally got to the point where they're like, you're done.
Yeah.
And that was a really great day. And then it launched and became an Amazon #1 bestseller, and that's a huge checkbox. As a result of this book, it created some relationships, and now I'm actually looking at doing a TED Talk later this year, which is another huge, like, holy crap, moment for me. So I'm looking forward to that coming up. And actually, all day today, I was working with the team on that. So it'll be interesting to see how that plays out.
Beautiful. Congratulations. Congratulations. All right. So, what did you learn about yourself in this process? So, I saw that, I'm hearing that you were able to receive support. I imagine some level of critique, some input from your mom and some folks that you really trust. But what did you learn about yourself? What did you learn about Patrick Grimes in the process of being an author while simultaneously still being all of the other roles that you need to pursue, right? A husband and or dad and or CEO and or authority or subject matter expert on a specific set of topics. What did you learn about yourself in that process?
Well, there's a couple fundamental things that I had to overcome. There's a little bit of that imposter syndrome where, why would I get out there and tell my story? And then, I got over it because I looked at a lot of the people out there that have written books, haven't done the stuff that I've done. And then I started realizing that a lot of individuals haven't been through a downturn and lost it all. They haven't had the opportunities to learn from and won't have the opportunities to learn from. And unless I get out there and share this and talk about it, I'm holding back stuff that could add value to others. So getting past those and owning my story, owning it, and being proud and vulnerable with my failures has drawn hundreds of investors to me. And I thought that's just such an incredible thing that actually shifted my investor calls now to lead with, I'd be happy to give you a copy of this book. It talks about how I lost everything early on and how I struggled, with the single family thing and I figured it out on scaling into larger multifamily and diversifying into energy funds. And people resonate with that. I think that was perhaps the best educational experience for me and definitely taught me how to connect with the audience.
Awesome, man. So let's talk about that. So you've made a move into energy funds, right? And what does that mean for your investment group and or investment body? Where are they now seeing the shift? Because you're now moving from investment properties into something that is still known to be on the rise, but that maybe isn't necessarily known by the most common person out there. So what does it mean to shift from real estate investment into energy funds?
Well, the platform Invest on Main Street really is talking about not Wall Street. And when we launched into the private equity syndications for multifamily, we're in such a hot market. Things are going well, rinse and repeat strategy. But in the back of my mind, I have been, and forthright in all my investor calls, I had always been talking to my investors saying, hey, download my passive investor guide. It talks about the diversification of the middle class, the high income earners, and the ultra wealthy. And the middle class actually have 8% of their assets in what are known as alternative investments. The high income earners have 25, the ultra wealthy 50% in alt assets. And in this alt asset column, there's a lot of different things other than stocks and bonds and annuities and stuff like that. There's private equity there. And what happens to be most commonly gravitated towards are by the wealthy are tax advantage assets that are still needed in recession resilient ones. And it happens to be the IRS, not just housing, but also they subsidize food and energy.
Yep.
They need us. The government needs us to house, feed, and energize America. And so by offering, and we just finished a second fund, and by offering another opportunity for cash flow and appreciation in an essential need that provides that monthly passive income with an exit and tax savings, that helps round out a portfolio, where they're non-correlated. They don't ride the same market cycles. So your whole portfolio might not be down all at the same time. And we're at the opportunistic fund, we're doing something similar, where the typical multifamily deals or the real estate market might be in a correction. The opportunistic fund plays on a specific strategy that allows us to take opportunities where we can win from that recession and see a growth in our income through, even though there's inflation and interest rates. And so the essential goal of our company is to provide these opportunities to diversify like the wealthy, but make them available to ordinary, hardworking Americans like I was, so that you can escape the grind, right? And not have it all in the volatile sentiment stock market or your 401k or IRA. And that's really what I'm passionate about, is helping people along that same journey I did, that gave us the time freedom and the location freedom to really focus and do what we want with our lives.
So whereas real estate and energy might both be opportunities, they are typically driven by different factors, which then allow for you to have diversity in your portfolio of investment, so that if one is experiencing a downturn, it may not necessarily have a direct correlating effect to the other. Correct?
Correct. Yeah. So the cyclic nature of cap rates in real estate, not trending to the price of oil or natural gas,
Cool.
right? And so you're unlikely for them all to be down at the same time.
Absolutely. So is diversity of investment a strategy, or do you double down on the things that you're finding the best immediate return on?
Well, it's kind of a combination, right?
Okay.
Because you don't want to invest when you want to go big on something that's on the way down, but you do want to build a portfolio of non-correlated assets within your investment portfolio. And that's really the traditional path that Americans are bred with, is go get a job, identify as a doctor, identify as an attorney, and be too busy to deal with your finances. So just give it all to your 401k or IRA.
Yeah.
Or maybe a financial planner, which just puts them in the same stuff that's in your 401k and IRA. And somehow that's okay.
Yeah.
And what's unfortunate about that is it's not okay. And regardless of whether or not you believe it's the case, you are the chief investment officer for you and for your family.
Yeah.
And unless you take a percentage of that identity of your laser focus and being like an engineer like I was, or being a doctor, attorney, entrepreneur, brand builder, and you put a piece of that towards using the cash wisely that comes from that income, then you're really doing yourself a disservice. Now, there's really very few opportunities available to Americans in all of these non-correlated investments. And there's very little education on how to find them, how to vet them, do the due diligence on them. And that's where Mess on Main Street comes in. We come into a place where we put these deals together, we locate, we operate, we do these things where we have a track record, a high degree of confidence, and we help piece together a fuller portfolio for people that are off being really good at whatever it is that they do. And I love that, because I used to do high-tech machine design, automation, and robotics, and work with some of the smartest people in the world. They didn't have time working for Tesla, working for Apple, working for Johnson & Johnson or Abbott to manage their investment portfolio. But they do have time to make passive investments into deals like ours.
So
as long as we can provide that.
Like, hey, what's my buy-in? What's the threshold in which I can become an investing partner into whether it's real estate, or if we're talking about any of the other additional like fuel, power, right? We're talking about some other additional investments that are available to me. What am I looking at in terms of like my baseline investment? Like, what's the threshold in which I can come in and really take the capital that I have and do something effective with it?
It's a really good question. And in our investments, we've made a choice to do investments for what are called, the SEC calls accredited investors.
Okay.
That means you have $1 million in net worth, not including your personal residence, or you make $200,000 a year for the last 2 years, or $300,000 if you have a spouse, combined with your spouse. And the reason why we do that is because that's the only way we can publicly talk about our investments.
Yeah.
If we go for accredited investors, I can have this conversation with you now.
Yep.
If I didn't, and I brought in individuals that had any kind of income, any kind of net worth, then the SEC would be like, no, you can't get on a stage, you can't get on a platform, you can't talk about it. And that goes against our whole ethos.
Yep.
Dion. So the challenge is somebody like me's got to get out there. We've got to make it available only to accredited investors. And we oftentimes have 100,000 minimums, and sometimes we've done 50 or 75. But we've got to get out there. Now, if you're not accredited, that doesn't mean that there aren't deals for you.
Yeah.
If you set up a call, we can point you to those, but it's all relational. It's all pre-existing relationships. They can't do what I'm doing and talk on a stage. So it's a catch-22. I'm happy to help out anybody that's not there, but for our deals, accredited investors only, usually 100,000 minimums.
Absolutely. All right, cool. So listen, Patrick, I have a question I ask everyone on Man versus Brand. All right. So on any streaming platform, books, podcasts, Netflix, all that stuff's included. What's something that you have recently engaged in that you thoroughly enjoy?
I would highly recommend the latest book that is out, and I'll see if I can pull it up,
Okay.
by a colleague of mine. His name's Trade Taylor, and it's A CEO Does These Three Things. A CEO
Okay,
only does these three things.
only does these three things.
Yeah. Yeah, and he just put it out. It just went on the market. He just did a presentation. It's gone bazonkers. He just spoke at MIT on it, at their business school, and he's a family office that invests with me, a good partner. Extraordinary book. I run every morning around the lake behind me, or I've always run every morning since college, and I listen to podcasts, I listen to TED Talks, I listen to educational and self-help books, and that book, A CEO Only Does These Three Things, 100%. It is rocking my world. I usually watch books at like 1.5 speed because my brain goes so fast. Yeah. I dialed this down to 1.25 speed, and it's so densely packed with cool analogies about the history of Napoleon and just all kinds of stuff, and just brings in all these, and then he brings it current, that I dialed it down to 1x. And I have never done that. I don't even remember the last time I watched a video at 1x or listened to an audiobook at 1x. Definitely, Trade Taylor, check that out. It's an incredible book.
All right, cool. It'll be in the show notes and in the description for YouTube. All right. So second question, on any streaming platform, book, podcast, Netflix included, Amazon Prime for those folks, Hulu, all that, right? What's something that you thoroughly enjoy that people might not necessarily believe that you do, right? So people in your life may not necessarily know that you like this area of podcasting, or that you like this genre of film and or TV, or that you read these sort of books. Like, what's something that people may be surprised to find out about you, but that you thoroughly enjoy?
So from Southern California, I love smoking meats. I watch a lot of sous vide and Texas style barbecuing.
Okay.
strategies. And my wife and I will actually pull the smoker out. We'll smoke a brisket for like 18 hours one day, sit in the hammock out on the porch, and just love every minute of it. And so I have this little bit of a, Texan smoker boy in me. I don't know where it came from, but it's there. And I don't think I really talk about that. It's probably something nobody knows about.
That's awesome, man. I'll find some material for folks to follow up if they're interested in learning about what it is to smoke meats and to and possibly some aging stuff too, because aging is also really awesome when we talk about meats. All right, so Patrick, this is your opportunity to talk to the listeners and watchers and let them know where they can get more content and information. We see investonmainstreet.com as a part of your profile name, but give us some spaces. Like, are you on Instagram, Facebook, LinkedIn, like Twitter? Where are some spaces where folks who are interested right now can also find more information aside from investonmainstreet.com?
So we're heavy on Facebook and LinkedIn mostly. We also put some stuff on Instagram as well. I do short videos, and we have educational pieces. I speak on stages, and I think we repurpose that stuff up there.
Cool.
So just check out Invest on Main Street, Invest on, and then Main, and then Street. Just search for that handle on Facebook and Instagram as well as LinkedIn. You'll find us. You also find us at investonmainstreet.com. And that's our website. If you're looking for the book, it's investonmainstreet.com/book.
Okay.
And that's the secret link. So they have to go to that exact link, use the Man vs. Brand in the promo code, and we'll ship you a signed hard copy out.
Awesome. Guys, listen, that's something that you definitely want to check out when this episode launches. I will make sure that if you are listening and you get that, make sure that you definitely tag us to let us know that you use that URL so that we can make sure that we circle back to Patrick and just say thank you for the signed copies. That's really something special and interesting. Hey, I lost you for a sec.
There you are.
Yeah, okay. I don't know what just happened, but I'll figure out. I'll edit this thing to make it work. All right. So if you have received the book, then definitely let us know so that we can let Patrick know. So tag us, let us know that you've gotten that copy. Thank you all for listening and joining with us on the Man vs. Brand podcast. If you're listening to this on Spotify, Apple, SoundCloud, any of the other audio platforms, and definitely check us out on YouTube. If you're watching this on YouTube, then make sure to go to all social media platforms and check out the shorts and reels that we have with Patrick talking about not only investment, but his own personal journey into building a life worth having. Thank you guys so much for listening and watching. Thank you, Patrick, for being on, and I appreciate you all.
Thanks, Dion. Excited.
Thank you.